Hello friends, in the series on the income tax cases, today we will discuss an issue that if an assessing officer rejects the books of the accounts of the assessee on the facts which are wrong and the facts are not as per the records of the assessee, and after rejecting the books of accounts the assessing officer accepts the figure of the financial statements of the assessee for making the addition. So whether these additions which are justified on the wrong rejection of the books of accounts are justified. And the second issue was that if the assessee has prepared its financial statement according to the percentage of completion method and as per accounting standard 7 and as per ICDS, then in that case whether the addition on the basis of difference in the 26 AS receipts and the receipts as per profit and loss account is justified. And the third issue was that if there is a waiver of loan in favor of the assessee, whether that waiver of loan is taxable in the hands of the assessee for the assessment year 18-19. These all three issues have been taken up by Honorable ITAT B bench in the case of Deputy Commissioner of Income Tax versus NAPC Private Limited. This issue has been reported in 121 ITR Tribunal at page number 544 and the date of the judgment is 14th August 2024. In the present case, this fact was very clear and the assessee was able to demonstrate that the assessee has followed the percentage of completion method and the books of accounts has been prepared by the assessee as per accounting standard 7 and as per ICDS. The assessing officer alleged on the assessee that the assessee has not shown the contractual receipts of some clients, and on that basis the assessing officer rejected the books of accounts. This finding of the assessing officer that the assessee has not showed the receipts from some clients was incorrect, and after rejecting the books of accounts of the assessee under section 145 subsection 3, the assessing officer selected the figure of the contractual receipts of the assessee and applied a arbitrary rate of 8% into the income of the assessee. Apart from that, the assessing officer made the addition of the difference between the 26 AS receipts and the receipt shown by the assessee in the profit and loss account, and the third addition was regarding the waiver of the loan claimed by the assessee from its lender. When all these issues came for the consideration of the tribunal said that in the present case the addition of 8% is not justified and it is totally arbitrary. The assessee has prepared the books of accounts according to the percentage of completion method by following the accounting standard 7 issued by the Institute of Chartered Accountants of India, and the assessee has duly complied with the income disclosure standards. So in the present case, the accusation of the learned assessing officer that the assessee has not shown the receipts from some clients was not justified because these findings were dehorsed the facts. So the tribunal said that in the present case, when the assessing officer has rejected the books of accounts, then in that case that becomes very clear that books becomes unreliable and the assessing officer cannot took those figures for making the addition, and hence the addition of 8% of the contract receipts was not justified. And since the assessee was able to give the total reconciliation of all the receipts, so the difference between the figure of 26 years contractual receipts and the difference as per profit and loss account was also not justified. The tribunal said that in the present case, the waiver of the loan was added into the income of the assessee, which is not as per the law because addition cannot be made under profit and gains head, and at the same time the addition can also not be made under section 28 clause 4 because the loan waiver of 50% done by the assessing officer is not as per the law. The assessee was claiming the interest on loan regularly into the books of accounts, and the tribunal was of the considered opinion that the nature of the loan has no correlation whether that income will be added into the income of the assessee or not. At the end of this video, once again I am repeating the name of the case. The name of the case is Deputy Commissioner of Income Tax versus NAPC Private Limited, and this case is reported in 121 ITR Tribunal at page number 544, and the date of the judgment is 14th August 2024. Thank you, friends.